8:33 this Wednesday morning. Thanks so much for sticking with us here on ARC Rochester. It's time for Wealth Wednesday. And as we gear up for the start of the new year, we're also looking ahead to tax season.
Yeah, there are a few changes coming in 2026 that could even save you a little extra cash. Here to break it all down is wealth advisor Jarrett Felton. Jarrett, thanks for coming in. We appreciate it.
Thanks for having me. It's great to see you. Every day's a holiday and every meal's a feast.
Yes.
Here we go.
Love it. Let's get into it.
Yeah.
So tax season, I can't believe we're already thinking about that.
It's December. Here we are.
Here we are.
It is. It went pretty quickly.
Yeah.
So.
I'm sure me, are getting a little stressed. You know what I mean? Because it feels like as soon as you get everything done and you finally get it all squared away, you're already back to
You got to start again.
Step number one.
Yeah, no, we're sitting here talking about holidays, especially travel. You know, what are you buying for people gifts? And the next thing you know, you're talking about New Year's resolutions and what the heck's going on for January. So, yeah, here we are.
All right, so what do people need to know going into 2026?
Right, so I think, you know, this is a very pivotal time in the year because there are a lot of commitments that we made to ourselves personally about what we wanted to accomplish financially in January. Maybe February, March. A lot of people lost everything come March with regards to what they were going to do. But since we're at the tail end of the year, there's really three things that I think people should take a look at. There are many, but I just thought I'd narrow it down for today since we're on limited time. First thing, you're like, yes, I know, keep going.
Yeah.
So, right, got it. So the first thing is I'd say take a look at your pay stub. I know I say that quite often, but I always think it's healthy to take a look at that. Most people never do because it is electronic. I know I haven't looked at my own, even though it's my own company. You know, I'm going to go in and take a look at it myself. How much have I contributed to my retirement plan for the year? There are caps and limits, but a lot of people think that, yes, I'm maxing it out because I'm putting in the most and just enough to get the employer match. But the amount is over $23,000 that you can put in as an elective employee. So just make sure that you're doing that. It'll help you on the pre-tax, reducing your taxable income. If there's a Roth component, it won't help you from a tax income reduction, but that will help you down the road on the Roth component because we all know that compounds tax deferred and you pull it out tax free. So that's really the first thing. The second thing, also know that if you are not in a 401k plan or you have the ability to contribute to an IRA, you know, you do have the ability to contribute to that, but you can do that by tax filing deadline of 2026. So don't feel like you have to just hurry up and write the check now. But if you got it, get rid of it because you may spend it over the holiday, as we alluded to earlier. That also goes for the traditional IRA, the contributory IRA, and the Roth IRA. And then last but not least, you know, those that are still working between age 60 and 63, there is an additional catch-up provision. So as we all know in the 401k, or as we may not know, you can put in the $23,500, but you also have the ability, if you're over 50, to do the catch-up. Right, the $7,500. But if you're 60 to 63, you could put in a total of $11,250. So that's a lot just to throw in there. But it is something just to keep in mind if you're still working and employed in these ages of 60 to 63. You could sock away a little bit more money to get you ready for those retirement days, golden years.
All right.
Yeah.
Talk to us about families, because I'm sure we have some watching us right now at home. Any changes to the child tax credit?
So I always want to leave with the fact I am not a CPA, so I would highly encourage you to talk to your CPA or a trusted tax advisor. So obviously during COVID, there were the child tax credits that people actually received in the form of checks in the mail. You know, whether or not they still qualify, depending on the child's age, whether they are truly a dependent or not. There's a lot of moving parts in that space. I don't like to speak to that because we all know kids are getting older. And some people age off the payroll, as some parents would say. So I would encourage people to talk to their accountant, to talk to actually see whether or not the child tax credit is going to be applicable to them or not.
We talked a little bit during the commercial break about the situation if maybe somebody bought a car this year and how that could help.
Yeah, so something new is for 2025 through 2028, if the vehicle is assembled in the United States, there's a lot of parameters around it. There's some income restrictions, right? So if you make too much, this may not apply to you. But this is the first time that I've ever seen a time where someone can actually deduct their actual car loan interest up to a max amount of $10,000. They don't have to itemize to get it. It has to be under 14,000 pounds. Just some things to think about that we haven't really seen in a while. That's kind of come full circle. That was in this big, beautiful bill that was passed earlier this year of 2025.
Where do we find a scale?
A scale? Oh, for the vehicle. Got it. I caught on really. I weigh myself three times a day, so I knew what you were talking about. I got you. But 14,000 pounds, you're like, what am I going to do with a 14,000-pound vehicle?
Yeah.
Right. So, well, some people try and get sneaky with it and use it for work purposes, so you got to be careful because there are some restrictions around that. We've helped some clients navigate that space. We go right to our partnered irs.gov to understand what the rules are and the qualifications are and the things that you can't do. And all the game is really just making sure you understand the rules and you play by them.
Fair enough.
So real quick, some other things just to know, since it's December, it's the end of the year, I won't see you till January. I'm going to miss you guys.
Oh, we'll miss you too.
I know. So something to consider for people that are of required minimum distribution age, so 73 or older, make sure you get those distributions out of your retirement accounts before December 31st. You don't want to get dinged or penalized because that is a pretty hefty fine, and it's an simple fix. It doesn't cost you anything to take your distribution. It is taxable to you this year, but just be mindful to do it. Not all custodians or places where your money is managed notify you. There's a lot of people that I would consider seniors. AARP defines them as 50 and older, but for these purposes, it's 73 for the required minimum distribution. A lot of them just don't really communicate with their advisors all that much, right? So I would encourage them to reach out to their trusted advisor, or if their kids are listening, reach out on behalf of mom, dad, get their permission or their blessing, and just move forward with that so that you don't get in trouble.
Good advice.
Yeah, that's pretty
Jared
good.
Felton, hit him with the website. Where can they go to learn more about you and your services?
Sure, Investment, invessent.com. Come on down, it's great. We got a lot of good things cooking down there. You can see my buddy Tommy Leroy, who's at the office doing the operational side of things for financial planning and portfolio construction. And we got Lydia, who's the head honcho, really the boss and the glue of the firm, Lydia Kerr. So I love everybody on the team.
Very good.